Thank you, everyone, for coming back for the Q&A. We appreciate your participation. The way we'll start it off is just simply, if you have a question, just raise your hand. We have 2 mic runners, and a mic runner will come over to you so that everyone can hear your question. It's always tentative for who's going to be the first to ask the question, and then it gets going. But please, if you have a question, just raise your hand. We've got one over here.
Sorry, quick question. You had the one chart up with the European companies being valued less than the American ones. And I wondered if the discount was because of demographics.
Thank you. I think that's going to be a question for you, Ben.
Yeah. It's not demographics. It's, number one, and this is nuanced. Historically, Europe does trade at a slight discount to the American market. But really, given the concerns on the conflict there, and the ramifications of the conflict, that's a concern. And that's started to abate in some ways, not the conflict itself, unfortunately, but one of the concerns was the energy crisis that Europeans are facing. And so that started to abate. We've had one of the warmest winters, and that's allowed storage levels for energy to ramp up. And hopefully that protects the European market from weather patterns and from an energy crisis at the end of this year.
We've got a question at the back.
Hey guys, my question's for Ben and maybe Bijal, and maybe John as well, but you talked about fixed income that you're looking at returning about 5%, yet you have inflation at 5.4%. Let's say it goes down to 4% or 3.5%. So you're looking at a real return of 1.5% to 2%. Why even bother with fixed income and just put more into private debt where you're seeing the yields of 10 to 12%? I imagine there's obviously financial planning issues, but at the same token, if we're looking at return and long-term returns, why are we even there?
Yeah, I can start with that. So you're completely right. If we take a look and we separate fixed income to the interest rate component versus the spread component, the attractive portion is the interest rate component. So cash is extremely attractive at these levels, right? Investment grade bonds, banks are trading at, let's say, about 150, 160 basis points. So that spread is not overly high. Generally speaking, when we get into a recessionary environment, spreads go north of 200. But there's 2 things of note. One is the all-in yields are attractive, so even if spreads widen, we're immunized from that situation a bit. Secondly, I quoted numbers from the market, and we take a different approach than the market. And I'll give you an example for fixed income. I think fixed income indices are quite terrible, and I know lots of people follow them. But for our fixed income portfolio, we take a look at the highest credit quality companies. So we have a lot of exposure in senior secured bank debt. And the positioning we have is that the banks will not go bankrupt. That's the position. And we lever that about 3 times, and so our yield is actually significantly higher than the market. We hedge out some duration risk to get low duration. And so we're getting about the same volatility as the marketplace, but we're getting 8 to 9% yield on those investments.
Bijal, did you want to follow on from a private debt perspective?
Yeah, we love the private debt market right now. I showed you the charts of 10 to 12%, which is the all-in yield. The nice part about it is the base rates have gone up. That may come down, so the yield might come down, but the spread above the base rate has also gone up. So we're getting a double impact helping those yields.
Yeah, maybe I could just add that if you're looking at private assets, then maybe the comparison really is between mortgage rates that we get in our pools and the private debt. And so yes, if the private debt's got the potential to generate a 10% return, at the same time, you're going to get 6.5% to 7% in the mortgage pool. So therefore, now that gap is narrower, and the mortgage pools are definitely lower credit risk and higher liquidity and higher turnover as well. So I think you want to recognize that there's a mix and match in terms of any risk management approach you take. And so if you took a combination and said, would I generally get a better coupon on a private loan than a publicly traded loan? The short answer, relative to the credit risk, the short answer is usually that would be the case, and it certainly is the case today.
Good question, Rob. Thank you. All right, Matt, let us have it.
Question for Mark. Obviously, real estate's done fabulously well for Nicola over the years. Nicola's growing, the real estate pools are growing. Any comments on your pipeline for opportunities as you look forward, as you try to invest the dollars?
Yeah, I definitely, with the rise of interest rates that's happened over the last 9 months, there's a capital squeeze that has happened in the marketplace. So we definitely can see opportunities now surfacing in the last few months, and I think it's going to continue, where there's going to be some great opportunities for us to come in, whether it's taking over an existing project that's under construction or buying land. There's going to be many different creative ways on how to buy real estate with VTB. So we're excited about that. We're watching, like a lot of people. There are a lot of groups on the sidelines, but we're not. So we're still active, but we are taking a very cautious and careful approach.
Yeah, hi. Both for Mark and John, I guess. The idea that equity and debt markets, you look internationally, we're just talking about Europe, but in real estate we have the 3 funds, but they're all North American. Is there some potential for future growth, either partnership or developing expertise on other continents or internationally?
Well, according to Mark's new best friend that I met about 2 hours ago, the short answer is yes, and he can't wait to provide us with all of those international equity, real estate equity opportunities. So do you work for him? I just wondered about the question.
Yeah. It's a plant.
Yeah, I was just thinking that. All right, Mark, you want to jump in there?
Well, in terms of hard assets for real estate, we've been very specific about what markets we want to go into. We have a cluster strategy. So rather than being, say, in the US, which is 10 times the size as Canada, we've chosen, say, for the industrial target, to be in 6 cities, which is Seattle, Minneapolis, Denver, Vegas, Phoenix, and Dallas. And we're trying to build bases, and we see us bolting on, whether it's Salt Lake or it's Reno or it's Nashville. I mean, we're going to keep adding them as we go and build up bigger positions. So the point I'm trying to make is, I think there's a lot to conquer still in Canada and the US. And we have not looked beyond. We have not had that request from clients saying, geez, I really would like it if you would buy hard assets in Europe or Mexico or wherever it is. So I think we got enough to cover off in our markets.
I mean, there is, I was being a little facetious there about the comment about Mark's friend, but that MSCI has a database, and many institutional investors, including ourselves, report into that database, and it's done country by country. And I think they've got 17 countries covered for real estate performance over, in some cases, many decades. If you take a look at the data on a risk-adjusted basis, North America is one, if not the best market on a global basis, let's say over the last 20 or 30 years. And the difficulty is, if you think about it, there's some logic to that. From a demographic and a population growth perspective, looking at the developed world, where do you think the population growth has been the highest? In the developed world. Okay, because it's not Europe. Maybe to some degree England, absolutely Canada and North America, based primarily on the fact that we have a relatively strong immigration policy to counterweight the fact that we don't have a much higher birth rate than, let's say, most of Europe. But it is slightly higher than most of Europe. Okay? And so in terms of Asia, interestingly, developed countries in Asia have imploding birth rates. The birth rate in Korea most recently was 0.8. The populations are shrinking in Korea, in China, in Japan, in Taiwan. And so ultimately, real estate responds to the number of people that are going to live in a particular environment. So you go statistically with where you have the highest probability of growth in terms of that real estate. And even as Mark will say, we have to, especially in the US, but to some degree in Canada, you have to then say, inside even countries that are growing, where would you choose demographically, economically, and all of the other factors to go? We're not everywhere in the US by any stretch of the imagination, nor are we everywhere in Canada. So we still have to pick those spots. But these two countries definitely have demographics and population growth working on their side.
This question's for Mark, and it's around self-storage, and I apologize in advance for the multi-part question, but can you talk a little bit about, on the Canadian side, if you project 5 years forward, how many assets do you want to have in that space, number one? Number two, you're heavily concentrated or exclusively in Vancouver or BC. Where does Ontario expansion play? And then three is, are you primarily looking to construct and develop on your own or acquire other assets?
And was the last two questions specific to self-storage?
Correct.
Yeah.
Thanks, Dave.
Okay, so the key to the barrier to entry to self-storage, I believe, is having a management team in-house. You can own self-storage and outsource that to a third party, but I really think you're running a business that happens to own the real estate. So we're very fortunate that we have an amazing in-house team, management team, that then inspires the people in the front line dealing with our customers. So that's the first thing that's key. So I'd like to grow this portfolio to 25. In the areas that I see for growth, we're going to continue in BC. Obviously, we're in Vancouver. Squamish, we're going to expand on Vancouver Island because there's lots of good growth there. But the definite target for us is Toronto because it's growing so fast. The storage market is more competitive here. And the painful part about building new, which is what we want to do, the new traditional 4-story in an urban location, is that the time it takes, and it's the same issue in Vancouver, to get it entitled and ready could take 2 years to get a property entitled and ready to start construction. That's exactly what's happening in the property in Oakville. It's taken a long time, and it's not, it's just, that's the process you go through. So I see the growth, a combination of building new, maybe buying an existing building that's been vacated, which we're looking at something right now where you can convert it to self-storage, or you buy it from a ma and pa who has built it, one off, and they go, no, we don't want to be in self-storage, so we're going to sell it. And that's what happened in Victoria. And it had some surplus land, so we can bolt on more. So it's kind of all the above. It's not just building new, it's existing and kind of the hybrid.
Mark, you were talking about Toronto vis-a-vis Vancouver. Did you want to comment at all on the US and self-storage?
Yeah, so it wasn't what we were planning to do, but an opportunity came across. We actually have 4 we're doing in Denver right now. It's a very strong market in Denver, a lot of residential growth. So we've got 4, 2 will be ready in the next few months. Actually, the first one's opening tomorrow. And we've got 2 more that'll be early Q1 next year. And these are your traditional 3, 4-story urban locations, and it's very well spread out in Denver. So that's the first market we're doing our test run. The rates in Canada for storage are almost double what they are in the US, just because it's more competitive in the US, double. So Canada's a very popular storage market, and especially Vancouver, right? So we are gonna go responsibly and in the US. I could see us looking at, say, Phoenix or Vegas or Dallas next. But we're starting with Denver.
Mark, what is it that's caught your attention in Minneapolis?
We weren't looking to go to Minneapolis. Actually, Colliers called us and said, you guys should look at this market. And we did a deep dive. Anytime we go into a market, we do a very deep dive, and anytime we buy any asset, we go to our investment committee. So what we do if we go into a new market is we put a detailed document together on why Minneapolis with, what are the economic drivers, universities, airports, all those things. And obviously the primary thing I look at is what's the vacancy rate. And anything under 5 is good, but anything under 3 is really good. And in the case of, say, Toronto or Vancouver, it's under 1. Is really, really good. So we bought it, ended up buying it off of Blackstone, and we thought, okay, Blackstone has it dialed in, they have it, they're doing a good job, but we found that there was some really some low-hanging fruit for us, and our team got in there, got
Mark,
even further
can you
increases.
just describe the asset for everybody?
It was a $230 million acquisition, 19 buildings, very well diversified, multi-tenanted, for 2.1 million square feet. So we got a great position, and we're very happy. Our team is getting outperforming on the rent increases. And again, that vacancy rate is very low, so that's what caught our attention. But we weren't looking to go there, but somebody brought it to our attention, did the deep dive, and we said, let's do this.
We've got a question over here at the back.
What's your general outlook on tech, right? So, and it's a loaded question. I work in tech, but ChatGPT, David, you mentioned it, right? So many are calling it already like a Kodak moment in IT industry, right? Its potential to disrupt the services industry is like immense. So in terms of like private equity as well, Bijal, that you touched upon, what's the allocation there? Like what's your outlook and approach basically when it comes to tech?
So for clarity, is the question, what's our allocation to investing in AI?
AI and other tech as like cybersecurity is booming right now with all these cyber attacks and everything that's going on. So just a general outlook, what's the investment strategy when it comes to tech?
Yeah, just for clarity, in the terms of the presentation at the beginning, I wasn't dismissing either AI or marijuana or crypto. Some investors have done well, institutional investors. The majority of retail investors got decimated last year in crypto. So just in terms, I just wanted to clarify that. And we have a number of themes, both within our public asset group and in private capital. And we do look at different verticals. And on the private asset side, whether that's health tech, education tech, Bijal, I don't know if you'd like to comment even further, but looking at AI or emerging technologies would fall into those different verticals within both private capital allocations as well as potentially on our public asset side.
Yeah, we've got some exposure mostly in our venture capital fund, where we would fund later stage companies that have a proven market concept, they've got customers, they've got revenue, and they're really looking for growth in terms of projecting it out and building in sales and other capabilities. So we've got an AI company that we have an allocation to. We've done some cybersecurity allocations as well, but mostly in those types of environments, they're all in the venture capital fund.
I would say probably on the private side as well, and Bijal's representing that area, that there's been a shift, speaking of sea changes, in the thinking of, especially for venture capital, but also for private equity as well, that investors are no longer willing to pay for growth at all costs. So basically, they need to see the cash flow. They need to see a business unit that's self-sustaining and that isn't simply going from round A to round Z before they actually see something that looks like positive cash flow. And that is an awakening for a lot of the founders of these companies that now are under pressure to show that they can generate a cash flow business that is able to create its own capital requirements.
I'll add to that. One of the areas that I really like is in the infrastructure space. And it's not directly in AI, but it's cloud computing, and it's a picks and shovels type of investment. So we have exposure to hyperscale data center. So this is involvement in kind of mission critical data centers. It's used for things like banking, things that can't go down. And we have, the counterparties are the 5 largest tech companies in the world. So there's exposure in alternative ways, and it's a little bit of a safer way to play that trend as well.
Question over here.
Hi. So I guess this question is a multi-part question, I guess, for Ben or Bijal. So given the inversion of the yield curve, where do you, I guess if there's a projection of how the equities are going to unravel in the coming year, that's one part of the question. The other is the U.S. Federal Reserve is expected to, I guess, tighten a little bit more. And would that have an impact on how the Bank of Canada is forced to kind of, pivot? And if that happens, what's the consequential impact, in your view, to the borrowers in Canada, given the backdrop that we're already experiencing with the defaults and what have you?
Sorry, I didn't quite catch the first question there.
The first part was about the yield curve. Can
Correct.
can you elaborate a little bit?
Yeah, so with the inversion of the yield curve and how the market's supposed to be, historically, based on the historical precedents, I guess, how the market's supposed to, I guess, tank, for lack of a better word. So where do you see the S&P and the equities to kind of, to fare in the coming year?
Yeah. So I'll talk about how the market is pricing it in and why. So they're looking at a soft landing, and to engineer a soft landing, there's two key components of that. One is we need wage growth to be more muted. We need wage growth to come down, for inflation to come down. But to get that soft component right, we need unemployment to remain relatively low. It can come out, unemployment rates can come out a little bit. They're at 50-year lows. So there is room to come up, but we need wages to come down, and that will help with the inverted yield curve to normalize it. If we don't see that, right, this is the part about earnings, and what we've seen with earnings so far is they've come down a little bit, but not overly too much. In fact, last year, we had obviously a very large correction in the equity markets. Earnings grew by 4%. So I think when we get to that environment, earnings will come down a bit more, and yes, there'll be a bit more volatility. Sorry, and the second part of the question was about the interest rate differential between Canada and the US, right? So Canada has intimated that they're likely potentially keep rates about this level. And the market believes that, yes, the Federal Reserve will continue to raise rates, but at a more muted pace. That makes sense to me, and the reason being is the Canadian consumer is considerably more indebted than the US consumer, and this is flip-flopped. We used to be in the reverse situation pre-Great Financial Crisis. During the Great Financial Crisis, both were actually pretty bad. Since then, the US consumer has considerably delevered, whereas the Canadian consumer has continued to increase their leverage rates. So because of that, I do believe that the market is being too aggressive for rate cuts both in Canada and the US, but Canada will likely cut rates before the US, and the interest rate differentials will impact things like currency and the markets as well.
Yeah, and you might want to add to that the US Fed is definitely more hawkish on the issue of rates than the Bank of Canada is. So likely, because we aren't going to see the decline in inflation at the rate that the Fed would like, and given the employment numbers we are still currently seeing, that the Fed's going to continue to raise rates, even if it's incrementally, and the Bank of Canada may not. And if that happens, you can expect a noticeable, significant pressure on the Canadian dollar. Bank of Canada doesn't care what level the dollar's at. It's given up that kind of peg approach. It doesn't worry about the fact that if the dollar drops to 70 cents, it's not going to be concerned. And so therefore, people should be thinking, obviously, if there's a small gap between our rates and the US rates now, but if that rate gap increases to, let's say, 100 basis points, you're going to see pressure on the Canadian dollar.
Yeah, I think what the Canadian Central Bank is concerned about is creating a crash in the real estate market. And so, I think we're kidding ourselves if we think that they're not speaking to each other in terms of the finance minister and the central bank head. And we've seen, the Canadian investor has got things wrong completely, and that's historically the case. So going back just a few years, 80% of mortgages were fixed rate, 20% were variable. Since then, the majority of new mortgages is actually variable. And that ratio has almost flipped, and now 50% are variable. And they've got the timing completely wrong. And so this rise in interest rates is much more impactful for the Canadian consumer. And that's why I think they can't keep it that long. They have to, at some point cut, because they don't want to engineer a large crisis in terms of the housing market.
We probably have time for one more question if there is one. That's great. Thank you, Victoria.
Thanks. John, I liked how you started off with a few macro trends, and one of them was climate change. And so my question was for Ben, Bijal, and I guess to a lesser extent Mark as well. How is Nicola positioned right now to for exposure on opportunities in decarbonization in the public markets and infrastructure funds, and even in across the traditional asset classes or in emerging asset classes, if there are any that come to mind?
So Ben, you look like you have something to jump in on that, but John, maybe you want to add just a backdrop of a few examples as well, just some thinking around ESG and the conundrum that it might represent.
So there's a framework that we've been working on now for, it's actually more than a year. And we've hired a group out of UBC called Campus Impact, and they have created two of the specialty funds, one for TELUS and one for Van City in Vancouver, designed basically to not just be strong ESG pools, but also strong impact pools, so that the distinction between ticking the boxes on environmental, social, and governance and making sure you covered them, but basically you're not really making an impact. So the fellow that runs the organization is a guy named James Tansey. He's a professor at UBC. And James has done a deep dive with his team with each of our 3 asset groups. And based on that, in working with each of them, has then worked on a model with us to develop a framework, basically an ESG statement for each of the asset groups that we then can represent to our clients as a policy. So with any luck, by the time things get done, we would certainly hope, certainly within the next 6 months, we can formally say, this is our position with respect to ESG in each of these asset classes. So, I mean, let me pass it back to these guys and they can respond specifically to what is actually currently occurring, but that's the overall framework.
Yeah, so in regards to ESG, on the public side, we take an integrated approach. So it's not necessarily just focusing on ESG and screening, but it's, okay, what are the benefits, what are the risks involved, both in all environmental, social, and governance. Particularly for, on the energy side, I think a large story for us on publics is the energy transition story. So we like natural gas. It's about 50% less polluting than other carbon sources, and we're focused on that. And we have direct exposure in other places too, like California carbon credits. So it's a market that's highly efficient. It exists in the northeastern states and in a large part in Europe. But a lot of people have a goal to be carbon neutral in 2050. California has pulled forward those goals. It's regulated by a couple bylaws. They have quarterly auctions for the credits, and it tracks CPI plus 5. So to me, it's an extremely attractive investment, and that's part of the solution. It's creating a price or cost for carbon emitters, and it's penalizing those who are over-emitting, and it's benefiting those who are progressing further towards the goals.
Yeah, and on our side, we're an infrastructure fund first, we're not an impact fund. So we look for great investments first, but then when we do the underwriting, that's when we tease out some of the ESG elements. We've got a scorecard that we use where we rate each aspect of it throughout all of our investments, and then that plays a factor in whether our underwriting says we should invest in this or not. But initially, our goal is always what's the best investment for that asset class.
And for real estate, maybe there's 2 parts to the answer. Certainly with ESG, our real estate team already has a policy that's going to be rolled up into a master plan for the company. But the E part is something that is a lot easier to measure. So there's things we can do to the buildings, which is more efficient lighting, better water monitoring, solar panels, triple pane windows, all those things we're doing, we can measure for cost savings. So we're doing that as a team with our assets. The other thing relating to climate change is insurance. So insurance has gotten more expensive. So you can imagine it doesn't matter what city you're investing in, there's always an issue, whether it's seismic or storms or floodplain. And so there's many things we do when we're looking at an asset, but one of the things we always do is we talk to our insurance consultant in-house saying, okay, this is the asset. They go to our insurance provider right away because they know what they're going to insure on. And if we can't insure, we're not buying it, because if it's in a floodplain or whatever the issue is. So we don't go all the way down the path to find that out. We do that right at the outset.
It's great. Thank you for that question. Thank you, everyone, for taking the time to participate in our Q&A. We thought that was a good turnout with all of you. Thank you again for everyone for attending our presentation this evening, and we hope to talk to all of you outside with some drinks and hors d'oeuvres. Good night, everybody.